Oh, definitely a blip. We think it was a classic bear market rally built on very fragile foundations. Our 2016 price forecast for iron ore is $50 a tonne, which implies a slightly lower price in the second half of the year to current levels. But let's look at the factors that drove prices up in April. Firstly, and most importantly, China's credit boost, which provided a shot in the arm for the property sector, but incidentally has not helped private sector investment in China at all, which remains very weak. Now, earlier this year, steel inventory was quite tight in China, so the stronger demand from the property sector quickly led through to higher steel prices, and for the first time in a long time, China's steel mills were making money, which of course incentivized production to rise further. Then we had a surge in retail investment in the rebar futures and the iron ore futures in China, which added momentum to the price rise, and iron ore surged up to $70 a tonne. But the rally faded as quickly as it started once the realisation dawned that underlying demand was still quite weak. Speculative money withdrew from the markets, and we're now almost back where we started. So where to from here? We think really sideways to downwards for iron ore, generally within a band of $40 to $50 a tonne for the next few years. We think the low point in the cycle will be in 2018 at an annual average price of $43 per tonne. Since the start of 2014, around 350 million tonnes of iron ore capacity has withdrawn from the market in response to low prices and weak margins. And this has been a combination of Chinese domestic supply and high-cost seaborne supply. And we do think these withdrawals are permanent. But the problem is that as these high-cost closures have occurred and the scale-backs, they've been more or less offset by expansions at the majors and the start-up of a few key new entrants. So the net impact on the supply side is that we've seen continued growth at a time when demand has virtually ground to a halt. Not in the short term, but commodity markets are cyclical, and this period of low prices and returns shouldn't last forever. I mentioned we think that 2018 will probably be the low point or the year of maximum pain in terms of low prices and weak margins for the miners. Thereafter, we expect pricing power to gradually swing back in favour of the producers. But let's not get too excited about it. Our long-term price forecast is $60 a tonne in real terms, which is only about $10 a tonne higher than the price today. There are some segments of the market which will fare better than others. DR-grade pellets could be in tight supply in the long term, so there's upward pressure on premiums. And on a regional level, India, of course, has enormous potential for steel consumption growth. And we do indeed forecast strong growth in Indian imports of iron ore, but probably not for another 10 years. So to summarise, we think that the iron ore market will get worse before it gets better.